Todd Halleck here, talking to you about estate planning with retirement accounts. Often when a client comes to see me, one of their biggest assets will be their retirement account. Could be a 403b, a 401k, an IRA, a Roth IRA. The tricky thing is these can be one of the most challenging assets to plan for in retirement because of the tax consequences that come with those retirement accounts. And those changed substantially about a year ago when the Secure Act went into effect in January of 2020. Some important concepts to understand when you're dealing with retirement accounts are the required beginning date and also the required minimum distribution. The required beginning date, sometimes referred to as the RBD, prior to January of 2020 used to be the year in which the account owner turned 70 and a half. That was the year when they were required to start taking required minimum distributions, or RMDs. As of January of 2020, it's now when you turn 72 is when your required beginning date and when your required minimum distributions will start. You can begin to withdraw from your account before that required beginning date as early as age 59 and a half without penalty. But once you hit that required beginning date, you will be required to start taking distributions from your retirement account if it's a tax deferred account. If it's a Roth account, there is no required beginning date for the original account owner. When planning for that, we have to take into account that the assets in a tax-deferred retirement account are what are known as income in respect of decedent, meaning that unlike a lot of assets you inherit, the beneficiary of that account will also be taxed on that account as they receive the money. Now, when we're talking about the beneficiary, there's several different kinds of beneficiaries that we could be dealing with. We could be dealing with a spouse. We could be dealing with a non-spouse individual. We could be dealing with a non-person, or we could be dealing with a charity. And each of those beneficiaries is going to have a different set of rules. If we're dealing with the spouse and the original account owner had not reached his required or her required beginning date, then the spouse has the option to begin taking distributions immediately, even if he or she is younger than age 59 and a half without penalty, or they can roll the account over into their own account and wait to start taking distributions until they do turn 59 and a half, and again aren't required to take distributions until they hit their required beginning date. This would allow them to maximize that continued tax deferral, or in the case of a Roth, that tax-free growth. A non-spouse, on the other hand, used to be able to inherit the account and start taking required minimum distributions, but they had to start taking it immediately. But they could stretch those over their entire lifetime. For individuals who died after January 1 of 2020, now a non-spouse is limited to having all of the assets distributed from the retirement account, that's tax deferred or Roth, within 10 years of the date of death of the original account owner. And so, that can really front load a lot of money coming into the beneficiary's estate that's taxable. So you have to kind of think through, how is that beneficiary going to inherit these assets that will now be taxable to that beneficiary? And will it be better for that beneficiary to take it all in one lump sum, maybe say in year 10, or will it be better for them to take it in increments over 10 years? But much more limited. And again, if it's taxable money, you're gonna have to think about what that's gonna do to this beneficiary when they receive that money into the estate. If we have a non-person, such as an estate itself, or a company, or certain types of trusts, that is actually going to be limited to 5 years from the date of the death of the original account owner, so an even shorter amount of time. So we really want to usually be looking at maximizing the amount of time that we have to get those assets out to the beneficiary and minimize the tax hit in any given year to that beneficiary. So we generally want to stay away from a non-person beneficiary. Now, some trusts can be drafted so that the trust itself is sort of ignored and we really get back to looking at the individuals. But you really want to be careful when you're doing that, because it could, like I said, reduce the time from 10 years down to 5 years. So lifetime, they can get it over their whole lifetimes, stretch it over their whole lifetimes. The non-spouse, you've got 10 years to get it all out. There's no mandatory distribution in any of those years. It just has to all be out within 10 years. A non-person, 5 years. Retirement accounts are great if you've got charitable beneficiaries or if you want to do any sort of charitable giving, because that charity is not going to be taxed at all. So if you want to give to your church or your university or something like that, the first place to start is with your retirement account, because that charity will inherit that without any tax consequence to that charity. And then if you want to give from other areas of your account to your other beneficiary, or of your estate to other beneficiaries, those amounts won't be taxed in the same way that the retirement account would be taxed. So charitable beneficiaries are great. So what's an example of how you might want to set that up? So if you say, I've got $1,000 in my retirement account and $1,000 in my bank account, and I want to split that 50% to charity and 50% to my kids. Well, if that all kind of lumps together, then the kids get $500 from the bank account, and the charity gets $500 from the bank account, and then the charity gets $500 from the retirement account, and then the kids get $500 from the retirement account less income taxes. So that's not a great solution, when instead, if we kind of planned it right, we could have had $1,000 go to the children from the bank account, they get the full $1,000, no tax, and $1,000 to the charity from the retirement account, they get the full $1,000, no tax. So more money went to your beneficiaries, less money to the government. So thinking through the different consequences of these different beneficiaries is really important. Other things you could consider doing, in addition to charitable planning, is looking at when you take your distributions. Maybe you don't wait until you're 72. Maybe you take them earlier because you're in a lower tax bracket than your children or your other non-spouse beneficiaries. Maybe you use some of this retirement account money and buy a life insurance policy that will replace the taxes that are lost, and then leverage it up into non-taxable inheritance for the kids. That's another option that some people consider. Kind of a mix of a charitable option would be to create a testamentary charitable remainder trust that will allow the charity to receive something, you get a deduction, and maybe stretches it out longer, when an income stream out longer to these non-spouse beneficiaries. At least 20 years you could, if you had the charitable remainder trust, be the beneficiary of the retirement account. How that works is the retirement account monies go into the charitable remainder trust. They pay to the children for at least 20 years, so we've got another 10 years, and then whatever's left in the charitable remainder trust upon the conclusion of that time period then pays out to charity. So that's kind of a hybrid strategy. So there's different things you can do with your retirement accounts if you're thinking through them. The worst thing you can do is just ignore them, because they are a big asset, there's serious tax consequences, and there's lots of planning options. Even after the Secure Act, which made life a little bit tougher on us, there's still things you can do. So I hope you have found this useful. I hope you'll think about this as you're planning your estate. If you have any questions, please don't hesitate to reach out to us. I hope you've liked this video. If you do, please plus like, and we'd love it if you'd subscribe to us. And until next time, good luck. Take care. Goodbye.